Clicked. All right. We are now live on YouTube. We're getting pretty fast at this, Mr. Pat.
How you doing, sir?
Doing good. You weren't on last week because you had a high-powered meeting. And how'd you shoot?
82. Not too good.
Really? I'd beg for an 82. So I'm not a great golfer, but I can always say I've hit some of the finest houses in the country, though. So that's my claim to fame. But so this is the channel where we talk about real estate and lending. I'm a realtor that's not trying to sell you anything. I'd love to, but we're just going to let the numbers lie where they are and show you what we see. And then Pat gives you kind of a behind the curtains look at the lending industry and some of the whispers that are out there, and in the hopes that you can make a good decision, but at least you're not going into real estate blind. Right, Pat?
Yep, exactly. I mean, there's a lot of information out there. We're drowning in information and starving for wisdom, as I say.
Well, this is an interesting week because there were a couple of companies out there like CoreLogic that actually came out and said, that real estate's is not looking too good going into 2021. And when you see that, and on Facebook, out come the real estate agents. Oh, they're wrong. We got this and we got that. And, none of us have a crystal ball. But when I kind of took a deep dive into the numbers, they have pretty good reason to be concerned. And CoreLogic uses the Case Shiller group, to get most of their data. And I know that they were pretty good at predicting where real estate was going to land back in 2006. They were shouting from the rooftop that things were starting to look bad, but nobody was paying attention to them. And so they're coming out now, and I'll share a couple. Well, first, before I share their numbers, we're going into the first weekend now below 9,000 units available in the Phoenix area. So this is the first weekend. We have always been running about 9,500 units, and then we dip down below 9,000, and then we add about 500 more listings back on as the week progresses, especially on Friday. Well, today we're at 8,800. So the first weekend. So we'll probably come out, if the numbers stay true, 88, probably 8,300 units on Monday, because they whittle away. So on the weekend, or for the week, we had 3,694 listings come up and 3,949 go under contract. So we lost an additional 255. So we've been running between 300 and 400 units less than the houses that come up for sale. So it's been interesting to watch as we go through it. I think I have. See if we have a message on there. No, that's not a message, but we're not getting any better. And now that we've got, this COVID not slowing down, evidently, people are even more reluctant to put their houses on the market nationally. This is a problem across the country. But the sales numbers, the number of homes that went under contract in the past 3 weeks in Arizona is shot up, straight up, back up to what we call pre-COVID levels. Mm-hmm. So sales was going along pretty good, and it didn't just slowly go up; it's a straight line up. And so there's some concern that if that continues at that velocity, that what goes up must come down. We may price ourselves out of the market, and people are running out like crazy, just panicking to try and get a hold of a house because there's low inventory, because you guys out there in the lending world have rates coming in below 3% now.
Yeah. Yeah. I mean, it's, if you buy your rate down, you can get into the twos. Right now, the market, actually, the bond market got hit today. It was down about 31 basis points. We hit yesterday, unprecedented levels in terms of all-time lows. But I'm seeing, you get to this point where rates are, matter of fact, there's some news. I just pulled some stuff up off of some data that, I talked to a couple months ago how there's a disconnect between rates the treasury market and lenders were not, they're pricing in a risk level for the forbearances and whatnot. And that there's a margin gap between, say, where mortgage-backed security market is and treasury. Those actually, that gap has closed. So the risk level has gone out, has come somewhat out of the rates. Lenders are not pricing in as much risk, but there still is some. It's come down. The spread on treasuries and mortgage-backed security market, there's a spread. And a couple months ago, that spread was real high, because basically mortgage-backed securities were really risky. But I was just reading here that this gap has closed, and mortgage rates are definitely starting to reflect it. The last week and a half, looking at my chart, the last 2 weeks, rates have gone down. They've slowly been a stair-step climb down. Today they corrected a little bit and they're down 31 basis points, but they're still, you on a purchase right now, people are getting quoted, you can, on refis, if you buy the rate down, you can get basically in the high twos, mid to high twos. And on purchases, you're looking at low threes, mid threes. But you're getting to a point where if the treasury market even went down even further, the mortgage-backed securities went up in price and down in rate, lenders are not going to, they're at a point now where lenders are not going to say, I'm not going to lend out 30-year money at 2.5%. They won't, there's a certain level where they're going to say, we're not going to do it because they're flooded already. To go back to the real estate market, I'm kind of getting off digressing, but right now lenders are just, they're behind. Right now underwriting times are at a regular, say a regular lender, XYZ lender, where their underwriting times would have been 1 or 2 days. Now they're 4, 5, 6 days, and they're still backed up. They're backed up with purchases and refis.
Did you see what Wells Fargo did this week?
I did not know. I did not see that.
They changed their requirements. If you're going to refinance, they wanted you to have, they don't want to refinance anymore. So their requirement is they will refinance if you have $1 million deposited in Wells Fargo. The minimum used to be $250,000. So they just don't want these loans on their balance sheet. And they literally said, we're too busy right now, and we want to cut back on that.
Yeah, that's what a lot of lenders will do, though. A lot of lenders they'll do that, or they'll raise rates, basically. And that's why there's sometimes a disconnect. People say, well, I saw, rates are going down here. Well, there's a lot of lenders out there that just actually raise rates to just discourage people from, it's like you're in the bread business, if you don't want to sell a loaf of bread, you'll charge $10 a loaf just not to sell it. Nobody will buy it. Yeah, and that's what they're doing with interest rates. So they're pulling back, but there's definitely a shift in terms of forbearances. We've been talking about the forbearances. We haven't talked about that in the last week or so, a couple of weeks, but I'm reading this data here that I pulled out because I can't remember all the data. It says as of July 7th, 4.14 million homeowners were in the plans which allow them to skip their forbearance. It's 7.8% of the mortgage lenders and just under $900 billion of unpaid principal. It said here, this is the smallest number of plans since April of 28th. And the thing of it is, Black Knight, the weekly report, said that it said here, numbers of mortgage loans and COVID forbearance plans shows that a decline in those numbers of nearly 500,000 last week. More than 435,000 homeowners exited their forbearance plan. They got out of it. That was the largest drop yet, they said. So there's people that are getting out of the forbearance. Obviously, they were doing it just to protect themselves, but they're getting out of it. 435,000 people got out of their plans.
That's a good sign. I read some other interesting numbers today too. Talking about CoreLogic. And it's interesting. It says, and I agree with the part of this, and then I don't agree with the second part. So there's two statements that they came out. One of the things that they said was United Airlines announced that 36,000 employees in the U.S. or 45% of its workforce could face involuntary furloughs on or before October 1st. That's a day after the restrictions attached to the $25 billion in payroll aid under the CARES Act expire. And I've been talking about October for some time now, saying, June and July may show us some indicators, but October is going to be the pinch point as people try to improve their Q4 numbers. And then CoreLogic added the following. They said, CoreLogic sees some particularly bad vibes for states like Arizona and Florida that are now confronting elevated COVID-19 state cases and the subsequent collapse of the spring and summer tourism market. This perfect storm will curtail home purchase demand over the coming year. Well, there's no summer tourist market here in Arizona. It's supposed to be 119 on Saturday.
119 tomorrow.
Come on out. So I agree that there's some stresses in the system and stuff, but as long as this inventory stays as low as it is, we're not going to see prices back off. But if it starts, people at the end of the quarter with these layoffs being where they're at, there's going to be people that are forced to sell. And so they're forecasting that going out into 2021, that we'll see, prices 6% lower by the end of that year. So it could just erase the gains that we're seeing this summer because of the inventory shortage. Because I think if we look out and we say, we've got 8,800 homes now, but then, you got the airline employees, there are so many businesses that aren't opening up in Arizona right now. And just people are going to have to put their house on the market either to move or just try to hang on to their equity. And I think that number will start moving up. What do you think?
Yeah, no, I agree. I mean, just to go on that airline employee, I had a client of mine. She's a flight attendant for Southwest, and her husband's a flight attendant for Southwest. And he said about 2 months ago, he said the same thing. End of September, beginning of October, it was the same. I can't remember exactly what he said, but he basically said along the same thing that you did. He said it. He said end of September, October, watch, these airlines are going to let a lot of people go.
Well, Wells Fargo, speaking to them again, said they're going to be laying off thousands.
Yeah.
And so we got another component in there that we really haven't talked about either, and that's the election. So looking at the studies on elections, do elections affect real estate? The answer is kind of and sort of, but not really. Because what happens is in September and October, when we're all busy arguing on Facebook, we have this anxiety and we kind of back away from the market, but it's kind of like crimping a garden hose. And so when you let it go, it goes back to the volume it was. So those people come right back out in January, regardless of which party wins.
Yeah. Yeah. In 30 years, we talked about a couple weeks ago, in 30 years of finance, when I was a stockbroker and 20 years doing, mortgages, I've never seen any time, every 4 years, I've never seen a time frame like where people have called me and said, man, I'm glad I waited till after the elections to do something because it really changed. It just same old, same old.
Never happens. Yeah. But I think the dynamic that you're going to see this year is that in September and October, the layoffs are going to start to become more prevalent and going to be really hitting the newspaper. And the anxiety, it will just add to the anxiety of the normal anxiety that we see in a presidential election. So I think it's going to be very tough times for people. And they're staying home now. Well, the buyers are not staying home now, but sellers just don't want any part of this. So they're sitting on their homes. Now you got all this refinancing going on. Everybody's sitting with a 3% rate. They may not want to sell.
That's the thing. That's another thing is about a year and a half ago, 2 years ago, I was trying to, when we were in a tough, tight market, last couple of years, but there's been periods, 3 to 6 month periods where it's really got tight. And I came up with the theory because I was talking to people and just listen to people. You talk to enough people on the phone, you got to get your own consensus of what's going on. That's why I think, us being in the field, talking to people, you got to get a feel of what's going on. But I remember back a couple of years ago, it was probably back about a year and a half ago, I said, and I think I might have mentioned this to you too when we talked, that back then. I said, and I know you probably remember me. I said, nobody's really moving because they've got a 3.25% interest rate.
Yeah.
And that, well, actually when it was when, and not I recall, it was basically the middle of 2018 to end of 2018, that 6-month period when rates went up to say, 4.5, 4.75, 5, 5.25. There was that spike in rates for that 6-7 months. There weren't any homes because people were like, I'm at 3.25, 3.5. I'm going to be good. I'm not going to sell my home. I'm just going to stay right here because rates are at 5% now. If I sold my house, I got a loan of 3.5. Now I'm going to go into a loan that's at 5.25, 5.5. No, I'm going to stay right.
That was the Fed's experiment in 2018, thinking that it was okay to start pulling back.
Yeah.
And they found out in 60 days that was a tragic mistake. Yeah. And now you hear Chairman Powell saying, we're not even thinking about raising rates until 2022.
Yeah. So that's gonna be the impetus as far as keeping the market strong. I mean, if you do see rates move up, obviously you're going to see, it's going to have a dramatic effect because people are used to rates in the low to mid 3s if you got good credit, or high 2s now, and you're like, hey, I just refinanced, I'm good to go for a couple of years.
Well, there's some nervousness in the credit markets because while everybody talks about homes being in forbearance, there is a tremendous amount of car payments being missed now. There are no forbearance programs for car payments. And commercial real estate, buildings that you go by and you see that nobody's leasing them. In commercial real estate, those are called see-throughs. There's nobody in them. And so a lot of commercial real estate, they're not getting their payments. So
speaking of that, I've got numbers on that. I saw in the thing, I sort of jump in, but they said that the survey found that there's hardships among members working on the commercial side of real estate. It says only 19% of property managers and 36% of individual landlords reported receiving all rent payments on time.
What was that percent again?
Only 19% of property managers and 36% of individual landlords reported receiving all rent payments on time. It's basically a survey, but it said further, 74% say they have, this is a survey that Black Knight puts out. I don't know how many they survey, but it says further, 74% say they have had leases terminated or tenants who need rent payment extensions. 56% of these were non-essential retail customers, and 38% were in the office sector. So it says consumers have been forced, and it also says here, consumers have been forced to move away from buying in stores and now are doing much more shopping from home. Unfortunately, this has come to a detriment of commercial property owners, but these circumstances could be an opportunity for growth in the industrial warehouse market as Americans become more resilient on home delivery services. And one more thing upon how the market's changing on that side. Talk about the residential. I'm going to jump back to the residential real quick, but they said there was reported changes in buyer preferences. About a quarter of these respondents in the survey indicated their buyers had shifted the location of where they intend to buy a house due to the coronavirus. A quarter, 25%. It says among those, 47% stated that their buyers prefer to purchase housing in the suburbs. 39% cited rural areas, and 25% said there was a preference for smaller towns. So you're seeing you're seeing a shift. It's based on this information I was looking at and reading that this coronavirus is obviously having a shift, a fundamental shift on people's where they want to buy.
Yeah,
buying a home versus being in an apartment. That's why you're seeing probably a push too.
Well, I had personal experience helping my son find an apartment. This is an interesting one. He was online and on the phone with an apartment complex down in Ocotillo. Or not in Ocotillo, down in Chandler. I think it was called Driftwood. It's on Arizona Avenue in Pecos. He wanted to get a 1-bedroom. So he's on the phone with him. He tells him, the unit number that you show, this is the one bedroom I want. It's $775 a month. And so he puts down the application fee, $45, and a deposit, which I think was $200. So he calls him back the next day and ends up talking to somebody else down there. And they go, oh no, that unit's an upgraded unit. It's actually $850 and it's no longer available. He said, wait a minute, I put my deposit down on one yesterday, speaking with somebody for $775, and that's what you have on your website. She goes, oh, well, that website hasn't been updated, obviously. And it was a total bait and switch. So he got his deposit back, but they held on to his $45 application fee. So he fired him off an email and said, come on, I applied for a specific unit. So long story short, we found this place up in Tempe, beautiful, small little one bedroom condo. And he saw it on Zillow, and I had sent it to him because Zillow is current when it comes to rentals, but it sucks when it comes to, residential resale. Right. Mm-hmm. So he said, hey, Dad, it's got an MLS number. And so I pulled it up, and this was like in the afternoon. Let's see, what's today, Saturday? So Thursday afternoon. And I said, oh, guess what? They have the application in the documents tab. So I downloaded it and I sent it to him. I said, you got to fill this out tonight, and it has to go to her now. I said, because this thing's going to go. It was the lowest price apartment from Tempe on down. Everything else was there. This was $750 and everything else was $850. And it was a sweet place. So we got it, and we went yesterday to drop off the cashier's check for him. And we met the agent, and she said everybody was peppering her with information on Zillow and emails. And we were the only ones that took the time to pull the application off of the MLS and fill it out and send it in. And they didn't want a college student. So my son isn't going to college, so he's got a full-time job. And she said she had 152 people reach out to her. So the rental market is still frantic, but I'm convinced that along Patchy and University, those luxury apartments that they built for students are going to be in trouble.
Yeah.
Harvard is still charging $50,000 a year, even though this year it's going to be all online classes.
I know. I saw that. It's amazing.
So it's, times are changing. People aren't going to go back to school. Now, my son, I probably didn't say it on here, but he had COVID, and it spanked him pretty hard for about 2 weeks. And then I know another young lady that had it, and all she had was a stuffy nose. Yeah. That was it. She's 25. And so it's out there, because everybody always says, well, do you know anybody that's actually got it? And then I kept quiet about it. It's like, yeah, I know somebody. He's high fever for 5 days. And pretty wiped out, really still trying to get his strength back. Saw him yesterday for the first time in 4.5 weeks.
Wow.
He's down about 10 pounds.
Good way to lose weight.
Yeah. I could think of a better way. But
yeah.
So anything coming down the pike this week? What do you think?
No, it's been rates are, nothing from a mortgage standpoint. Like I said, the lenders, what I'm seeing is the real estate agents are, what I'm seeing on the mortgage related Facebook posts, that I got a couple different Facebook posts that you got to get a feel and sense of what people are talking about. And a lot of them are complaining, that, agents are putting 30-day, they're trying 30-day escrows when it's taking about 35, some lenders, 35, 40 days to close, just because they're backed up. I mean, like I said, the COVID thing has affected everybody. The lenders, they're working, a lot of lenders, underwriters, processors are working from home. So there's that, they don't have that team unity in the building. Underwriters can talk to processors and vice versa. So there's, sometimes of a disconnect on the lenders. And these lenders, like you said, are normally, if they're 1 to 2 days in underwriting, they're now 4, 5, 6, 7 days in underwriting. I just talked to a lender rep last night, and she was asking me, we're trying to hire underwriters. And the problem is, in the lending business, you just can't go out and hire a bunch of people, because it is still a very specialized industry in terms of underwriting and processing. You just can't jump in it and just start doing it the first week. I mean, these guys have years of experience. And when we get periods like this where you get a refi boom and you got a busy purchase business, lenders are just maxed out in terms of business. So that's why it goes back to the interest rates. Why, if they lowered rates any further, they just can't handle that much business. I mean, I know that some of these bigger banks, like, the one with the Stagecoach and, these other big, the four big banks, I'm sure they're, typically when they get busy, they're 60, 90, 120 days to closing a refi. So,
well, I think if you're a buyer or seller right now, it's your best bet is to schedule a longer closing because, like we experienced this past month, that sometimes things just show up and delay it. And if you're trying to coordinate a move in and somebody else is trying to move out, give yourself some room. Going for the 30-day close now is risky. So give yourself some room. So even if the paperwork comes in a week earlier than we're expected, that's great. At least you don't get that last minute call that the closing documents are not arriving and now the moving date has to change, because there's nothing worse than calling a client that's already scheduled the moving truck and the cable guys and the painters. And it's, if you have a firm closing date and you've given yourself more wiggle room, it's better for everybody involved.
Yeah. In terms of first time home buyers, I mean, it's really getting dialed in the first 72 hours, getting all the paperwork together as much as you possibly can, and getting into lender as soon as possible. Give yourself just because, the appraisals are taking obviously a little bit, appraisers are, they're backed up too. I mean, so everybody in the industry is backed up. I mean, I had a buddy of mine who's another mortgage broker. He does good business. Does good volume. He's by himself, but he uses one specific. He's got a couple of title companies that he uses specifically, and he's got one title. He called me yesterday. He goes. He was so frustrated. He goes, I got this one title company. I call them to open up escrow, and they're like, we're too busy. We can't handle it. And he goes, I give them anywhere from 5 to 8 orders a month, and they said, we can't. We're not able to take your title order, because we're just too busy.
Wow.
The title company there's a lot of title companies out there for the title, and he specifically works with one or two of these title companies. And he said, I give this one title company anywhere from 5 to 8 orders a month, which is a pretty good number. Yeah. For anybody, whether it's an agent or a mortgage guy. And the lady said, sorry, we can't accommodate you because we're just, so for a title company to say that, he was just like, he was blown away, and I was blown away too. So people have to be patient, get all their paperwork together. They can't drag their feet getting paperwork in. Just get it in ASAP, whatever the lender is asking for. These underwriters, they're under a lot of stress. They're trying to get files through. I mean, I'm getting paperwork and emails from lenders, 9:30, 10:30 at night, 12:30 at night. So these underwriters are working from home, and COVID has changed their way of doing business. So, when buying a home, there just got to be a lot of patience. Chances are things are going to, when things are this busy, you love to obviously a purchase to go perfectly smooth, but there's always going to be that one or two hiccups that you just got to be ready for. And just take a deep breath, and it'll be taken care of.
Yeah, and the scary part is when you get into a market that's this hectic and this frantic, you see people writing offers on homes that are ridiculous. They're going way over asking price. They're waiving their inspection. They're making their earnest money a hard earnest money, and then they're saying, if it doesn't appraise for the price that I offer you, I'll make up the difference on my own. Don't worry about it. And if I'm a buyer that's thinking about buying right now, my advice is just wait this out, because all crazy markets eventually find some normalcy down the road. Yep. And so I'm not going to sit here as a real estate agent and say, oh yeah, it drives me nuts to see Facebook posts right now. It goes, I got my clients above list. Well, I mean, everybody's getting above list. That's not a badge that you can wear that it was just you. I mean, congratulations. I don't mean to be snotty about it, but but you know what I'm talking about. You see it on
Yeah.
Facebook.
Oh yeah, all the time.
But the other side too is I know so many agents they're just out there showing and writing and showing and writing, and they can't get the deal. And the only way to get the deal is to write an offer that wouldn't make any sense 2 months ago.
Yeah.
And so when I look and I see that, because I've seen it before, if you're not in a hurry, yeah, you know what, the prices might go up a little bit, but you're forcing the price up now by going out in a hectic market. So you might see something that's for sale for 385 now, and when you go out in a few weeks or maybe a couple months or 3 months, and it's now 400 or 399, that 385 house now is getting bid up to $400,000, and you find yourself having to not getting any help with title fees, and you've got to put in hard earnest money. So you see what I mean? You can get, so down the road, that price might be a little higher, but you're not going to have to bend on the necessary things such as an inspection and your earnest money and your appraisal.
Yep. I've seen this before too. No offense, because you're a real estate agent. You're an incredible real estate agent. You're one of the best out there in terms of just getting along with the client. You really have the best interest of the client at heart. I mean, I've been doing it 20 years, and I think you're in the top 1% percentile in terms of working with the client, listening to them, telling them you're not afraid to tell somebody, this house is probably not right for you. And you've done this. Your first dollar? Is that your first real estate dollar?
Yeah, no, I was just paying you for the endorsement. So no.
Okay. But it's true, because I've seen a lot of different agents. There's good agents, but then people have to realize there's a lot of agents that got in this business recently, the last couple of years, because things have been good. I mean, on the mortgage side, since 2011, 12, I rode through the 08, 09, the tough times. Now you're seeing a lot of mortgage people, last 4, 5, 6 years get in the business. A lot of agents get in the business the last 4, 5, 6 years, even the last 1 or 2, 3 years. And they don't have experience in terms of seeing their overall picture. They get caught up in this, irrational exuberance. And I've seen it where they start acting cocky. There's a cockiness that, I've seen this. And when you get really cocky with something, I don't know, but there's always that, if you're too high here and too low here, everything always has a way of bringing back down to the mean.
Well, I think you have to start thinking outside your industry. Now, when I was in sales with a baking company, and I would tell my sales managers, I go, you need to step back and look from the grocery side of it, not the wholesaler side. So you need to step back and pretend you're the buyer, and you need to start analyzing what's really going on in the industry, not your own little world. And real estate, I think, takes that and compresses it, because we're all in real estate forums. We're all getting the same newsletters from title agencies that tell us, where stats are. We're all reading the same internal documents. And so you have to step out and say, let me go read some independent economic data from like the St. Louis Fed. Get on and look at the real numbers. And because inside of those Federal Reserve reports, there is no rosy anybody trying to sell you anything. There isn't anybody trying to keep business where it is. It's here's where unemployment is today. Here's where rates are. Here's our projection. And here's where we see trouble. So I think as an agent, you need to start looking at some big picture economic numbers, and you can get your real estate numbers anywhere. So you can see what's going on. But I try not to pay a lot of attention to our inside the industry. And I don't mean to sound like cocky or insulting, but I don't like to be clouded from within inside the industry with an opinion. Just if I was selling, boats, and I just would be reading nothing but, why it's a good time to buy a boat and what kind of boat to get and everything. And I would forget that there's this whole financial wing out there that's maybe going to make it a hard time to sell a boat. So you can get slapped in the side of the head. So I think it's our job to let consumers know, buyers and sellers, well, here's some things that worry us, because outside of our little industry, here's what's going on a mile down the road that we should be watching.
Yeah. And I agree with you as far as like, there's more. I mean, not to be negative. I mean, I think people that are moving, buying a home, there's certain people that have to just do it. Like going back to what we talked about last couple of weeks or last couple of months, if you're, I know you're not discouraging people. You just say, be careful. Don't get caught up in, don't bid a house that's at 380, bid up to 420 and say,
I'm trying not to discourage you. I'm trying to say this is the time where you really got to be careful, because when it's hectic, we make mistakes.
Yeah.
And then we sit back and we've closed on the house. We sit back and go, we paid what for this? Oh, I forgot. I didn't have the inspection. I didn't know the roof was shot. So you don't want to get yourself in that situation.
And like I said, going back, I mean, people say and then people, the average person, they'll read stuff and they'll hear from Uncle Jim or the next door neighbor say, there's gonna be a crash coming. Like we're talking about this irrational exuberance. There's gonna be a crash. There's gonna be a crash. You know what? If we can get through this forbearances and, like you said, the numbers in the forbearances, obviously 435,000 people exited their plans, just recently. There's people that just did that. There's over $6 trillion, $6 trillion of equity in home equity out there.
Yeah.
I
don't see a crash. I don't see a crash. What I see is the eventual return to normalcy.
Yeah.
And the cost of that is going to be some pullback in pricing.
Yeah.
Because anytime you have an increase in inventory to normal levels, then pricing is going to get normal as well. So what I'm preaching from what's that?
It could be triggered by interest rates going up, but I don't see them going up for,
Yeah, I don't see rates coming up, and it could be triggered by, unforeseen hiccups in the credit market. If they can't get a handle on these commercial mortgages that aren't being, banks could really freeze up, lenders could freeze up. So, especially car loans and stuff. So I think it's worth staying on top of it and watching it. So that's why I really like to stay close and go, well, is our inventory improving or is it getting better? Or is it getting worse? And it's getting worse, 300 to 500 homes every week. And I can't even wrap my head around what this market would look like if we get down to 6,500 homes. If we're losing 300 to 500 net every week, 6,500 homes is not a crazy number.
Well, like we talked about, take the 6,500 homes. That's 6,500 homes, what, in the Maricopa area? County?
No, that's the Arizona Multiple Listing Service, which was just about the whole state.
Okay, but if you looked at that search, you have to subtract probably, I'm just guessing, 20-25% of those homes, because a lot of those homes are listed. The average person probably wouldn't want to live in it anyway.
10% of them are modular homes. They're in the outskirts, and they're in Waddell and Wickenburg and Apache Junction. So we're at 8,800 homes right now, and you probably only want to go see 10 of them.
Yeah.
And like I was illustrating last week, look, let me show you the neighborhood that I like to work in. You tell me you're going to get a house for $500,000, which is a reasonable price in that neighborhood. There's one. I want my kids to go to this grade school, this junior high, and this high school. What have you got? Oh, I have one. Yeah. And that's what really gets tough. So, when you drill it down. So next week, there is, I think, some of the things to watch next week. I think we're going to see more of a ramping up on not unemployment, but more bankruptcies being announced. And we are seeing some relief by some companies and financial companies that are vacating Seattle and coming down here because of the mess that they have up there. And so that's going to be interesting to watch, see if we start getting more and more of that, perhaps from California. And so I think those are numbers to watch. And Monday morning, I will be putting out the new existing sales and inventory numbers for everybody to see. So my projection is that by Monday at noon, we will have 8,500 homes available. So We're at 88 now. So we'll lose 300 over the weekend. But, you know, if we don't, it's only going to, because it's just too damn hot.
Yeah. Once you look at a home at 120 degrees.
It's, if it, inside the key holder, the lockbox, there's a black box that holds the key. And so you take your phone, you open up the key box, you get it. And then if you don't take that little black box and either carry it with you or put it in the shade, you can't pick it up to put the key back in and put it in there without getting burned. And I've seen agents wear like gloves.
Yeah.
And because I've been burned before. I would have, I'll pick up the key. Ah, shit. The hazards of Phoenix.
The risk of being a real estate agent.
Yeah. The things we didn't see. Well, Pat, have a super weekend.
Yep.
And,
you too, buddy.
Take it easy.
Say goodbye to our millions of viewers.
Millions. Yes, we have 1.8 million today. So
good.
We've set an all-time record.
All right, buddy.
All right. Talk to you soon. See you.
Bye.